What's going on, guys? Another Friday is here. I guess it would be an odd Friday because we got Patrick on with us again. How you doing, brother?
Doing great, brother. How about yourself?
I I'm in my place in Missouri. It's really you can't get better as far as I'm concerned. Working from here for the week, spent a lot of time with a guy. I've got a guy out here who's actually a professional trader. That's all he does. He trades all damn day long, and that's how he makes his money. Travels the world, trades off his phone, trades off his computer. He focuses on price action. And what I was showing the folks earlier this week on Tuesday that he looked at our MBSs, he's like, yeah, I can see the pattern. He goes, just in price action alone, I know where you're heading. And so he set some levels, and I'll show those here soon. Just going to get your take on it. But let's go back to what we had this last week. We had the Fed minutes, right? Fed's talking about and guys, the Fed minutes we have, those are from January. They're not like they were this last week. This is last month. They met, they compile all the minutes, and then they said they release them. I don't know why they released them a month later, but why is that? Let's tell the people why.
It's just simply because it's the best way to collect the data, correct? And it's the best way to assess it. It's so volatile, and it so happens that you can't stay live with it all. And the markets need time to digest what the Fed talks about within the meetings, but then because you've got to create a scenario where you've got the Fed meeting, right? That in essence, the rate decision is going to make a market reaction. The post presser is going to create a market reaction. So we're trying to not create a three-headed monster, right? So giving a little bit of lag time for the actual discussion to come out, to not have like this three-headed whammy against, whatever direction the Fed is looking to head that way.
So, okay, so I understand the three-headed whammy thing. You don't want to just knock it all to the ground, but what it seems like sometimes when it's coming out in succession like that, just as everything starts to stand back up from the beating it just took, you get punched in the face again. Starts to get back up after a few weeks, it's punched in the face again. So, and from what I'm looking at here and all the data, it just seems like we're going to keep seeing a negative direction or a bearish direction when it comes to interest rates. So the Fed talked about we're not going to lower rates yet. We think inflation is going in a good direction. We're happy with the direction, but we want to see a definitive move for the negative on the inflation, showing that it's more under control. But we got the inflation readings that they did not have. So they didn't have those inflation readings, the CPI and the PC and all these things. They didn't have that when they had that meeting. Then we get it between the time they have the meeting and the time the minutes are released, and we see that the inflation numbers went up.
We like to think that they don't have it, and they say they don't have it, but yeah, it's sometimes when you read between the leaves there, so to say, and you kind of see the actions of what they took. You listen to the post hike presser, and then you kind of study the minutes a little bit. Sometimes there's some similarities of understanding that what they're talking about matches what inevitably comes out. But yes, to your point, we got smacked both on Wednesday and Friday of that week when the consumer price index. The biggest key that the markets are looking for in CPI is the month-over-month movement, right? So the markets were expecting 0.3%. We talked about it in our morning update that it started to feel as if, this thing was going to miss to the negative, right? And then that's exactly what we got, was a 0.4 print. And then producer price index, the PPI, comes out Friday that week, and it smashes expectations, jumps 0.5% versus 0.1. So that was a double hit really for the markets. But yes, inflation absolutely killed it within those two reads.
Let me digest that for you guys, right? What he's saying makes sense to me, but normal average individuals, like, how's it killed it? How did it do that? Well, when you're only talking 0.1% or 0.3 or 0.4, it seems like that's not very much. But we're also talking about a month-over-month number. It's been trending up. Like, we're still expected to be 0.3% higher. We're still seeing it. We still expect inflation to be going up because it's always going up. It's continually going up. But they didn't expect to go up that much. It went up even more. That means inflation is actually rising faster than they had anticipated. So it's not under control. What the Fed wants to see is we want to see it 2% inflation. It means annual inflation of 2%. It's always going to go up. Things are always going to get more expensive, or the dollar is going to always lose value because of what they're doing, but not as fast as they're intending it to happen. So because of that, there's no chance. I see zero chance of them lowering interest rates anytime soon. Everybody thought first quarter. First quarter is not going to happen. They're thinking, well, maybe second quarter. That's not going to happen based upon that data. And there has been hints from members of the Fed that says Probably not this year. Have you heard that too?
Yeah, no, they have been very clear that it's going to be based on data dependency. And the Fed seems pretty split in this conversation. You've got Goolsbee, who's my favorite, who constantly discusses that, hey, we can't wait until we're at the 2% target to really start considering this. But then you have other Fed members that are saying, hey, this really isn't even a discussion right now, including Fed Chair Powell. So the Fed minutes did tell us that Fed members are truly split within the idea of when are we supposed to start this, right? Because they are in restrictive territory. They've discussed repeatedly that they're in restrictive territory. But the one key is the Fed could still cut 50 basis points and still be considered in restrictive territory, meaning that they're slowing down economic growth enough to maintain their monetary policy goals. So that's a possibility.
Yes, when you're talking about for monetary policy goals and things within their little ecosystem, when you're talking, in my opinion, when you're talking about a global thought process, you're talking about the consumer, they see the Fed cut by 50 basis points, then it's Christmas again, everybody's out running around, okay, things are getting better. I think that it has a negative impact on inflation as a whole for people in their spending habits for them to actually cut. And they probably realize that. I don't think Powell is going to let the cut happen personally. So let's get into some interest rate stuff, guys. Let me just tell you, if you're listening to the average person out in this space that has not having this conversation with you, is not pulling up data, is not dissecting things, not taking the time to lock myself in my Missouri cabin for a week, to bring a trader in here, he's looking at stuff, he's giving me things that he would look at, and not getting a guy like Patrick on here to figure stuff out. I think you're listening to the wrong freaking people. Let me share with you. I got some people this week calling me up saying, man, I've got this guy saying he can get me an investor loan at 7.25% to 7.5% with 0 points. It's not an investment loan, guys. It's not. Let's take a look here. This is where I tell everybody to go. Go to bankrate.com. Now, the reason I say to go to Bankrate, because they publish pretty much the most common rates you're going to see. You're going to type in bankrate.com. You're going to scroll to the bot down here till you see this girl on the yellow slide. Right below it says a better rate is waiting. Click on mortgage. What do you see here? 30-year fixed, 7.28%. That's the average person buying a house to live in, not you, the real estate investor. Don't use Bankrate to determine what's going on with you as far as a real estate investor. The other thing is the lenders you're talking to, the guys out there that are trying to earn your business, they're telling you all about where rates are going. I'm running into this shit all the time. They're saying, well, he says rates are going to go down. What data does he have? And let me show you something for you. We're going to get deep into this one in just a second, but this is the charts that these guys are usually looking at. Now, this particular chart is a good chart, and it comes from a guy who's extremely intelligent. He's actually been on this with me before. Great man, has done a lot for me and people in the industry. But here is a key area he is missing. See my red arrow right there? That red arrow, in fact, I can't even see where my cursor is on this thing. I'm at the C. I can't even see it. So you got my red arrow there. That red arrow, here's my cursor. I'm going to circle that red arrow. That goes right onto that line. That line is what I've been drawing, which has been my belief is the peak of what the mortgages will be at, because everything above that was only there because of quantitative easing. If we didn't have quantitative easing, we had never been into that particular space. So that's my thought there. So we're going to get into the chart Patrick brings up from that same source I just showed you. We're going to show you my charts. This guy had made a call to a lot of loan originators way back in May. What is it, May 10th, May 12th, something like that?
May 10th, 2023.
Okay. So we're right here. That's right here, guys. If you can see my cursor, May 10th of 2023, there was a call saying, hey, things are going to get better from right here. We got what was coming out at the time, Patrick?
It was a change in the calculation of shelter expense within the CPI report.
So change in the calculation of shelter expense in the CPI report. So what I'm going to do is I'm going to draw a line here on what that was right there. You're going to see right there. That's May 10th. That's where that is, where I'm pointing that to. Well, what happened? It bounced off of it, hit the level I've been talking about. Actually, wait a minute. I think I'm in the wrong. Oh, no, sorry. I'm looking at the wrong one.
You're right.
May is right here. May 12th is right here. That candle right there. That's the candle. So I was drawing off the wrong candle here. Let me put that where that is. Right there. So that's where that was. That call was made saying that we're going to see everything go to the upside. It didn't. It broke below that key level that I've been talking about, 100.53. That's established the day they announced quantitative easing. It went below it. It has never definitively been above that. And it's actually continued to follow a downward channel all the way, I wouldn't say into oblivion, but not far from it. So here's why we bring that up. Here's why I bring Patrick on to talk about these things. He's tracking these things like crazy. I'm not looking back on what other people called, but the bottom, because I'm looking at my charts, I'm looking at things that I understand. God bless these guys out there trying to do business. They're trying to give people hope for what's going to happen. But there's just a lot of hope floating around the market. Right there, because of that mistake, a lot of people didn't lock. They said, float this into it. And then they're like, oh, just keep floating. It's going to turn around. It never did. They may have caught half of it back, but they never caught even were close to where they should have locked when that level was, because the information was incorrect. So what I'm trying to explain with this is we believe where we are right now, we're in very, very treacherous territory. We have seen nothing but downward movement. There was a article that Scotty had seen this last month. The end of January says February is going to be a down interest rate. It was a down interest rate prediction, thinking things were going to get better. And he shared that with him. Like, guy, dude, there's no way. We're at my key level. We're at my 105.3. I don't believe it's going to happen. It continued to go downward. Look at this. It's like skipping a rock on a pond. It bounced. It's going to go right. I'm thinking it's going to go right back down. I'm going to share one more screen and then turn it over to Patrick a little bit, give some breakdown. But here is the levels that were drawn by my buddy, who is the professional trader. He says, this is our next level right here. He says he believes it's going to keep riding downward until we hit 97.77. We're going to test it, bounce off of it, and go right back down to 97.20 and work our way to 97.35. He says, this is where we're going to have our turnaround. He calls it an order block. This is where the money's hiding right there, waiting. Money's hiding right here, in his opinion, from what he looks at, price action, pushing it downward. Money is hiding here to push it upward. But here is and this is our big-ass trading range, massive trading range. Any thoughts on any of this, Patrick?
Yeah, so this goes into matches that should sound familiar, because I actually talked about that exact level in our morning updates as well. Because one of the things we're looking at is, there a lot of contracts can be bet upon in regards to 10-year puts, where you're betting in future price of 10-year treasury yields. And some of the puts for the April contracts are now supporting that the treasury yield is going to be closer to around 4.5, which is about 1/4 percentage point higher than where we even are right now by the April executions, right? So the market's starting to bet that reality of what you're seeing right there is a strong reality, and there's a strong chance that we're actually going to arrive at that point.
So let me go ahead and just put that into a very, very simple thought process. If you've got a deal you're waiting to lock, you probably should lock. We're sitting right on the verge of a lot of things pushing us downward. There's not enough news coming out, anything I think that would push us up to a level that would improve your rates. And the rates are not going to get that much better, because we showed you that key level from 2008 that it keeps hitting and does not get above, period. Yeah. So unless the Fed says, hey, we're going to start quantitative easing again, I'd say lock your stuff, keep it locked, and keep moving forward. And if you're losing money right now because you're gambling on a better rate and a better lock price, you lost it. It's just the way it is. I'm not trying to be a prick about this. I would love to say it's going to get better. I don't see anything that tells me that, and anybody tells you something different is just filling you full of hope to keep you in their database and keep you strung along till it hopefully works, so they can hopefully lock you and hopefully earn your business.
And here's one of the dramatic issues that occurs, right? So if you go kind of back and look at your chart there, what started February was, the jobs report, right? The jobs report absolutely crushed expectations. So then you have your average loan officer that says, hey, I missed the beat, right? I missed this economic report. So I'm going to push to the next one. I'm going to wait until CPI comes out, and CPI is going to change this direction. Right. CPI hits, we get absolutely no value there, right? And then I'm going to go to PPI. Now I'm going to wait on the Fed rate decision. So they keep kicking the can down the road, waiting for the next economic indicator to save them. And what we've seen in February is there wasn't a single economic indicator that actually gave any of the value back, right? So they're constantly chasing inevitably until they come back and say, hey, remember that interest rate we promised. Unfortunately, we can no longer honor.
So I try to get some people to lock some big group of locks right in here. And because of what that other person's telling them, they didn't. And unfortunately, that hope did not get fulfilled. And God bless the guy for trying, but man, I don't like to try with other people's money. It just doesn't feel right. I appreciate you, brother. Thank you always for being willing to jump on here and share your knowledge with the folks.
You bet,
Hope you have a kick-ass week, man. Thank you again, guys. Thank you for watching, hitting the subscribe button. Give me some good comments for Patrick. Give him some steam to keep doing what he's got to do.
Right. Have a great day, friend.
Thanks, buddy.